Neil, and thanks for joining our webinar today. Our webinar today is the second in a series of 6, and it is on pensions, retirement, retirement return and lump sums. My name's Carla. Before we start, we'd just like to do a little bit of housekeeping. Could I please ask people to mute their microphones? This just helps with background noise. And could I also ask people to turn off their cameras? This just helps with effective streaming. It's not that we don't want to hear from you. We'd love to hear from you. Could I ask you to use the chat box for any questions you have throughout? We have Dr. David Matthew on the chat box today, managing that. You'll meet David a little later. And just to let you all know that this session is being recorded. Okay, so a little bit about myself. My name's Carla. I work for an organisation called Arden and Gem, and I am the business manager and wellbeing lead. As an organisation, we support other organisations with their wellbeing programmes. I've 15 years in the NHS, and throughout that service, I've worked with scientists, patients and people. So today's financial webinar will be delivered by Neil. We've worked with Neil for a long time now. He's your expert. And what I would like to do is just offer a little bit of feedback with the financial wellbeing service we've done to date. Could we have the feedback slide, Neil? So you'll see on the screen, people couldn't be more satisfied with their one-to-ones. Phone discussions are really helpful. We'll talk through this as we go through the webinar, but please be assured that this education session today, you will be supported and there will be tips throughout. So I'm going to hand you over to Neil to do the rest. Thanks, Neil.
Thank you, Carla. Good afternoon, everybody. Hope you're all keeping well and safe. So, as always been alluded to by Carla, this is the second of a set of webinars that we're doing with your good selves. And this one is going to be completely focused on pensions and retirement wellbeing. What I want to get across first of all is just to explain that pensions is a wealth of information. It's a massive piece of information, and to get that all across, certainly just the NHS scope of it all, would be near on impossible in the 40-minute slot that I have. So what I've done is, over the years working with the NHS and Eulogie, we know we get the often questions, the common questions that we get asked on a very, very regular daily basis. Pre and post normal seminars and on phone calls and face-to-face meetings we have on a daily basis. So what I'm going to do is I'm going to go through those all for you and hopefully demyth a lot of the myths that are going around in the NHS. Today is purely awareness. It is education. And I want to give you enough information here today for you to start taking control of your own pension finances and finances standard as well. It is good quality, impartial information. We are not leaning on any, and as I've made very, very clear in my previous webinar and today, this is not advice. And just to express why that is the reason, I am a chartered financial planner. I practice, I'm regulated, fully regulated by the Financial Conduct Authority, who's our regulator, and the firm that I represent, Total Wealth Planning, TWP, we are chartered financial planners. And that means today is not advice. Today I am wearing the Eulogie hat. And Eulogie has been doing this for the NHS, the private sector, the public sector for 15, 16 years now, up and down the country. And what we pride ourselves in is giving you kind of a bottom-up approach and trying to self-diagnose, self-educate yourselves and hold your hand through the process rather than top-down, because I feel if we give you the information, you start coming on this journey along with ourselves and have a better engaging, a better relationship with your own finances. So once again, today is awareness only and education, not advice. I've just explained the main caveat, but I want to bring attention to the bottom bullet point here. I will be using today stereotypical scenarios. The pure reason being because I want to paint pictures in your minds and make this world of virtuality for yourself so you can understand what does this mean to you. I absolutely appreciate that not everybody's going to fall in these stereotypical scenarios, and I apologise up front for that already. It's not for exclusion purposes, it's just to help everybody out have some engaging what they can do with their finances. So First thing I really want to cover, and this was brought up in the last webinar that we did on general information, is the herd mentality. The NHS is full of herd mentality, and please take that in the right way. And where we mean by this is actually you are very accustomed to taking on board what your colleagues are doing, and you feel like your colleagues are doing the right thing, and therefore you think that is the right thing, and therefore you're going to do what you think is the right thing because your colleague Brian in radiography has told you he took the large lump sum, or he took his pension early, or Janet in catering has decided actually coming out of the pension complete was the best thing she ever did. Janet and Brian may know a lot about pensions. I'm not removing that fact whatsoever. However, do they know enough about you? They don't know about you, and we come across this all the time. Do they know how much you want to spend? Do they know what type of retirement lifestyle you have? Do they know what your partner's or spouse's income is going to be? What pensions they have in? And so actually what we're trying to paint a picture here is they don't. And this is all about you. Pensions, the way pensions are built is an individual product. You don't have joint pensions, you don't have individual pensions. So therefore you've got to come into it as an individual and understand and grasp exactly what it means to yourself. We know that when people are in a relationship together, they usually do mortgages together, they have children together, and they also plan to retire about the same time or thereabouts. So therefore, I've got circa 80, 90 people, I think over 100 actually, listening on this webinar. There could quite easily be 150, 200 of you because you have all got partners and spouses. And so the information I'm going to present today is very relevant to the NHS, but it's also generic information. It's pension law and legislation. And I'm going to try and get that across so this can support your outer friends, your colleagues, your partners and your spouses as well. Again, this is a slide that we've duplicated from the last webinar, but this is now going to be more focused on that stage 2. Remember, this is the wealth accumulation pot. This is where we want to aspire to be. And this is where we have more money going in and going out. And what are we doing with that money? Are we spending it? Are we saving it? Are we paying more for mortgages? Are we paying more into savings? Or are we buying shinier cars, spending more at Costa or Starbucks? That's entirely up to yourself. The whole concept of today is about pensions and retirement planning. And stage 3 is wealth distribution. Another word for wealth distribution, everybody, is that's a pensioner. That's the day you want to retire and live off your retirement income, which is a pension, your savings to give you that retirement lifestyle. And you could spend many years in stage 3. But if you want a good stage 3, everybody, you need a really good stage 2, a really planned, thought out stage 2. And the sooner you do something about it, if you realise you've got £100, £200 better off each month, do something wise with it. Put a bit into savings, put a bit into pensions. Absolutely have a nice lifestyle with it as well. But start beginning to have that compromise. So without further ado, let's just focus on the pensions and retirement planning. For an educational purpose, there are 3 types of pension, everybody. You've got the state pension, you've got the money purchase pension, defined contribution pension. Many people whose partners or come from a previous private sector life would have had AVCs, stakeholders. That's a defined contribution money purchase plan. Nest, which the NHS offer, usually for retire and return, which we'll touch on later on, is a defined contribution money purchase pension. And defined benefit pensions, final salary, is what the bulk of the NHS pension scheme is on, and we will touch on all bits. So the first thing we want to touch on is state pension. Let's get this one kind of wrapped up. The state pension changed massively, absolutely massively in 2016. And the reason I'm trying to really highlight this is you now need 35 years of national insurance contributions to get the full state pension. Now I'm going to set a stereotypical scenario, but it's a very common one that we see circa 2-3 times a week at least. Ladies, this has affected ladies the most. So ladies have children, and stereotypically ladies have time out of work to bring up the children. And that means they could be out of work for 3, 5, 10 plus years. If you're not in work, you are not paying usually a national insurance contribution of some description. So therefore, somewhere along the line, your pension pot is being hit. Your state pension pot is being hit. For this scenario, Janet's actually brought up the children for the last 10 years. She's returned back to work, gone back to work for the NHS. She's now in the NHS and she's in the 1995 scheme, and everybody, the 1995 scheme, the normal retirement age is 60. now wakes up on her 60th birthday and says, look, I'm going to retire now. And she looks at her total reward statement and can see that actually she can live off a £12,000 a year pension. Not a problem. Wind the clock forward now to 65, 67, whatever her state pension age is going to be, and realises now that she hasn't got a full state pension. That is simply because she hasn't done enough years. She had several years out of work bringing up the children, and she's retired, not gone back to work, and not paying any national insurance from age 60. So therefore, she's really squeezed that window of opportunity to pay national insurance contributions. And that happens a lot. So the way to kind of remedy this scenario and get yourself around this scenario is ask and request for a state pension forecast. And to do that, you simply go into Google or Bing, open up a government gateway and request your state pension forecast. This will be tailored to you as an individual. It will tell you what national insurance years you've done to date, how many years you need to go, what is your state pension age. Again, ladies, state pension age used to be 60 for you. Because of WASPI and bringing in line with gender, you now retire pretty much the same age as the males. And especially ladies, you will find you may have a retirement age of 65 and 7 months, 66 and 3 months. What I'm trying to say to you here is this misconception that people think they retire on their 66th or 67th birthday. No, there's still a phasing in period, everybody. So again, ladies, you need to know this information and get to know what your state pension age is. Also, your state pension age is very relevant to your 2015 pension scheme with the NHS as well. It is a good gig. It is paying just over £9,000 a year right now based on a full state pension. It is triple locked. Now, triple locked means it keeps up with the highest rate of inflation. And inflation, everybody, is the cost of living. You want to keep on top of that. You were highly likely contracted out of your pension, or you were contracted out of your pension with the NHS, which means there may be some deal of national insurance deficit there. You are not worse off, but actually, again, your state pension forecast will tell you how much you're contracted out by. So again, familiarise yourself with this piece of information. They will also allow you, if you have got missing years and you're coming up to retirement age, state pension retirement agencies, they have given you the potential to buy back added years. That's what's called a class 3, a national insurance class 3 contribution. So please, again, just get your head around that, and is it worth paying into or not? So first of all, homework on your to-do list is get yourself a state pension forecast. You do have to request your state pension forecast, and you do have to apply for retirement. Some people have said they still get a pack through the post. We do find that few and far between. Be proactive, get the state pension forecast. When am I going to retire? 66. I would certainly be knocking on their door 65 and 8 months old, just to find out exactly what do I need to do now to get my money. So pensions, NHS pensions. There's 4 pensions. There's the 95 scheme, 2008, the 2015, and Nest, pension ultra enrollment. And people will come across that when they do what's called retire and return. The second thing on your to-do list, an action point, is get yourself that total reward statement. I've brought this up before. Total reward statement is gold dust. It will tell you what your normal retirement age is. It will tell you what pension schemes you're in. It will indicate how many years you've done. Now, on your total reward statement, you will find, again, especially ladies, we've just talked about that moment where you may have had time out with children. You may see your membership years with the NHS could be, say, 30 years. But your reckonable service, the amount of service you've done with the NHS as working and towards your pension could be, say, for example, 24 years. And it will also indicate that. Some people have moved from trust to trust, and sometimes they find some of their pension hasn't followed them. So please understand this in advance. It's always best to have an argument with pensions prior to retirement than afterwards. So again, request that. And again, that's usually done through the government gateway or your ES. So let's remind ourselves what the main pensions are. You've got the 1995 scheme. The bulk of the NHS have been in here. And that is you joined the NHS before the 1st of April 2008. Your pension, the 95, is based on your best possible pay in the last 3 years up to your retirement date. Your normal retirement age is 60, but it is age 55 if you're a special class or mental health officer status. And again, your total reward statement will clarify that. And once you inflation, the cost of living, again, it's CPI, Consumer Price Index. The 2008 is when you join the NHS between the 1st of April 2008 to the 31st of March 2015. Now, this is based on the average of your best 3 consecutive pensionable pay years in the last 10. The normal retirement age for this is 65. Some people did do what's called options too, and they moved from the 95 to the 08. When you do draw your 2008 scheme, it is CPI linked, so it keeps up again with inflation at Consumer Price Index. The 2015 scheme is the new kid on the block, and this is where we're finding a lot more people going to be phased from the 95 or 08 into the 2015 scheme, or you joined the NHS anyway from the 1st of April 2015, and by standard you would just be put into the 2015 pension scheme. This is a career average revalued earnings scheme, and you cannot take your money from the scheme without a penalty until your normal state pension age. Hence why I'm asking you to get your state pension forecast so you can see how the two do marry up and dovetail. And that's the only similarity they have, it's just that pension age date. These are the big questions. These are the questions we're asked on a very regular basis. When can I retire? How much money do I need to retire? I'm in more than one NHS pension scheme. How does that affect me? Retire and return, pros and cons, winding down, the large tax-free lump sum or the lower tax-free lump sum, Neil, or I have other pensions, including partners and spouses. I said right at the beginning, we've got to bring them into the fold as well. They're part of your retirement planning as well. Merge the first 2 questions together. When can I retire and how much money do I need to retire? First of all, let's just try and make it clear. If I wake up on my 60th birthday, I know I can retire on the 95 scheme. There's a lot of reasons why I can and why I can't. And I have this relationship with the cookie jar. Just because I can eat my cookies doesn't mean I should, because we know what the repercussions could be and a lot of weight would be put on. Look, just because you can retire, it doesn't mean you should. Only we're going to be talking about throughout this afternoon's webinar. That's when you can technically retire without any penalties. Your normal retirement age for the 95 is 60 or 55 special class. The 08 is a 65, and 2015 SPA stands for state pension age. Everybody, the pivotal, the most influential mechanism of you retiring and throughout our lives, and what we can buy and what we can't buy, and the haves and the have-nots, is all down to the cornerstone of financial planning, and that is income and expenditure. To the right, I have laid out your core expenditure and the discretionary spend and retirement lifestyle. Your core expenditure is made up of those expenditures you just have very little wiggle room: mortgages, debt, food bills, utilities. Those bills actually only usually go one way, and that's upwards. Your discretionary spend, gym membership, your lifestyle, your retirement lifestyle, the meetings out, seeing the grandchildren, etc. They're the nice to haves. And again, we'll go back to this golden box scenario. If you want the nice to haves, and you want to sustain that throughout your retirement lifestyle, it's about now. It's about the planning of now. But it's also about doing your due diligence. And I would certainly recommend, and we were happy to send this out to you. I know Carla and David have access to the Word document version of this, and happy to send that to yourselves. And this is what we use as professionals day in, day out, is you need to make sure what your income is now and what your income is afterwards. And that is pre-retirement and post-retirement. And so I will come across scenarios where I had a client of mine last week who earns £40,000 a year. NHS 95 scheme pension is going to give her £10,000 a year, and she was keen in retiring. The simple maths is, I'm going to call her Janet for this scenario, is Janet, you've gone from a 40k salary down to £10,000 a year pension. There's a 75% decrease. Can you live off that? Eyes wide open, and that's what it's all about. It's awareness and eyes wide open. Neil, I can't. So actually, Janet really has options, and we'll touch about those. But actually, the main option she went with is, Neil, do you know what? I'm going to carry on working for a couple of more years because I just simply can't afford to retire. That's not a bad thing. There's nothing sinister about that. It's actually doing the right thing mathematically and the right thing for your family and your retirement lifestyle spend. Remember, by delaying your retirement by a couple of years, you're closer to state pension age, and that will then give you that better retirement lifestyle. So income and expenditure is absolutely essential in any. And so we call it the leaky bucket effect, and people will just think that money will stay plugged in. Your money still goes out, everybody. You know this. I know you know it personally. that you still have bills to pay, you still have lifestyle spend to go, but you only have so much money going in, only new money going in. When you retire, remember, potentially you're going to have no new money coming in unless you go back to work. And that's something we're going to touch on later on. So again, income and expenditure exercise. Do one pre-retirement, one post-retirement, or one ready for retirement, so you know exactly what you can't and can't afford. Simple as that. Now this is massive because this is going to affect a lot of people. And this is, Neil, I'm in more than one NHS pension. How does that affect me? Again, we've seen this slide already, but we have got three schemes: the 95, the 08 and the 2015 scheme. All three have different retirement ages: 60, 65 and state pension age, or 55 for special class status. So let's understand that. We've got to understand that bit first, hence why I'm asking you to get your total reward statement. This cruncher, this is what's happened, and to give you some education around what made people go from the 95 to the 2015 scheme, or what's made people go from the 08 to the 15 scheme, or why some of your colleagues haven't moved at all. Why they just stayed in the 1995 scheme or the 08? Why haven't they been affected? And it was all down to your age, which there's no wiggle room on, unfortunately. So I'm going to set an example, and I've highlighted the bits that are really important to you here in red. I wake up as a person on the 1st of April 2012, and I am aged 51. I'm in the 1995 scheme, and I know my normal retirement age in the 1995 scheme is age 60. The rule is, on the 1st of April 2012, if you were within 10 years of your normal retirement age. So on the 1st of April 2012, as waking up as a 51-year-old person, I am only 9 years away from my normal retirement age. That means I stay where I am and carry on working. Restrictions, which is affecting a hell of a lot of people, is on the 1st of April 2012, I wake up as a 49-year-old person. And what that means is actually I'm 11 years away from my normal retirement age, because I'm in the 95 scheme and my normal retirement age is 60. And therefore, I'm 11 years away, not 10. I'm not within that 10-year bracket. Now, if I was 48 or 40, it applies. That's basically telling me and telling all of you that you will be phased in to that 2015 scheme pension. And the 2015 scheme pension, everybody, the phasing in, as I've put to the bottom part in the red, is still going on. The phasing in process started in 2015 and will conclude on the 31st of March 2022. So there is still many, many years of this phased in process still to go ahead. There are people here today who know this, fantastic. If you have never seen this before and unaware and think it's affected you, I'll be certainly asking you to speak to NHS Pensions directly to get your relevant forecasts, and I'll give you those details later on today. So, I've been phased over to the 2015 scheme. I know I've got money in the 95 scheme, but I've been now told the 2015 scheme. And this is what's going to cause some headaches here, because actually what's happening here, I wake up on my 60th birthday, I know I can access my 95 scheme with no penalties, as I've highlighted and read there for you. But I've got money in the 2015 scheme, and I know I can't touch that till I'm 67 because my 2015 scheme is in line with my state pension age as well. If I decide to take money from there, I will be hit by a 31% penalty. So you've really got to now work out what is the best option for you financially. What are your options? What I've done is I've laid out a number of options for you. I'm not saying this is exhaustive, and I've done it from 1 to 5, and this is no mathematical order you should approach. It is entirely up to yourselves, remember. This is about you. But the first option I've put down is you wake up on your 60th birthday, you've done your income and expenditure, like my client last week, Janet, and do you know what? I can't afford to retire. I just continue working. Or I do a bit of winding down, so I'll go part-time, and I'll be touching on that factor later on today for you. But what it means is simply I'm no longer paying into the 95 or the 08 scheme. That's been deferred. I am actively paying into the 2015 scheme. But even with that, I just can't afford to retire, so I just carry on working. The second option is you retire. I retire, I take my 1995 scheme pensions, and I just don't take my 08 or 50 scheme because I know there's going to be a financial penalty. So I retire, I know I can live off that pension scheme alone, I don't touch the 08 or the 15 scheme until the normal retirement age of 65 or state pension age. There's going to be many of you here thinking about a thing called retire and return. So some people will retire. They will take their 1995 scheme pension, but they'll return to work and make up that difference by returning to work, but won't take their 2015 scheme benefit until the state pension age. You can take all your pensions if you wish to, but as I've alluded to already, there will be percentage penalty hits. You convert that into pounds, that can add up to a lot of money. So there will be percentage penalty. Go in with your eyes wide open. I would certainly probably advise you actually do speak to a professional before you do that as well. Persons, and unfortunately this does come across now and then actually, where, Neil, I don't understand it. Okay, so what have you done? I just came out of it. No education, no professional advice, haven't sort the right thing what to do. I've just come out of the NHS pension, kind of ran away from it, buried my head in the sand, what you call it, tell it yourself. Very, very rare do we suggest people come out of the NHS pension. With all that's gone on in the media, etc., about NHS pension, the NHS pension is a fantastic thing. And so therefore, it's very rare to advise anybody to come out of that at all. So if you have done, please seek financial advice to make sure it's the right thing to go back into. And if you are thinking about it, again, please speak to a professional just so they can talk you through, look, these are the pros and the cons. If you are planning to retire to return, this is the bottom bullet point. If you retire from the 95 scheme and you return to work for the NHS, you are not allowed to pay into that 2015 scheme pension. There's a bit of a myth that you can do that. You can't. Right? As simple as that. When you retire from the 95 scheme, you are actually retiring. You have to walk out the door typically. So we're going to talk retire and return, which is the theme that we're on at this present time. Retire and return it's part of the NHS flexible retirement theme, which is fab because they're trying to keep people within the NHS. There's a lot of intelligence, a lot of knowledge and experience that needs to be passed on and used on a daily basis. And what the scenario we're in right now, COVID, is more apparent than ever. But retire and return had a lot more weight into it several years ago and beyond. Because again, I'm using stereotypical scenarios, but ladies, it's affected the ladies the most. Ladies, you wake up on your 60th birthday, you can draw from your 1995 scheme, no penalty. But remember, ladies, you could also then take your state pension age at age 60 as well. So you suddenly had your NHS pension, state pension, and then do you know what? You thought, I quite miss my colleagues. I wouldn't mind doing a couple of days a week. I don't do 5, but I'm quite happy to do 2 days a week. I like the camaraderie. I'm going to return to work. So you've now got an NHS pension income, a state pension income, and an NHS working income. A lot of the ladies I spoke to then, it was the best financial position they ever had. The children have gone off, they've done their thing, and no mortgage, and you're just saving it in life. But again, a spanner hits the works, and we all know now, ladies, the state pension age increased in line with gender equality. So there's now pros and cons you've really got to think of. And I think a lot of retire and return theme has stemmed back from those days when, ladies, you could retire at 60 without and take your state pension at all. So again, if you are thinking about retiring and returning, I would be certainly strongly recommending you do an income and expenditure document. When we were asked this question, Neil, I'm going to retire. Brilliant, well done, Janet. Thank you very much. What are you going to do? I'm going to return back to work. The question we go back with is, but if you're retiring, well, I'm returning, Neil, because I need the money, because my pension's not good enough. Now we're having the conversation, well, should you really retire anyway then? Because you certainly can't afford to retire because you just told me you can't, because you need to go back to work to make up that difference. So we will say to anybody, and this is devil's advocate, but this is the way a professional will work, is if I wake up on my 60th birthday and I retire, it's because I can afford to retire. Simple as that. If I return to work, it's because I choose to go back to work. Not like Janet has to do, she has to return to work to make up that financial differential. Now, some people will be here today saying, yeah, but I'm doing it because I want to go part-time. And there's a few other options I'm going to show you later on. There are other options out there, and I'm going to highlight one certainly. But please think, retire and return is not the whole enterprise of retiring, and then that's that. There are other options out there. And whatever you do, as you've seen this slide before, income and expenditure, absolutely critical. So I've done pros and your cons expenditure, and life is about pros and cons, let's face it. If you stay in the position you're in right now, you keep your permanent position. So you've got a guaranteed job, basically. Your death in service, you keep that. You remain in the NHS pension scheme, and they are very good. You have your 6 months full pay and your 6 months half pay. And again, with the crisis we're going on right now, we know a lot of your distant colleagues, and you will know probably some of these on a one-to-one basis, are now beginning to have to use the 6 months full pay, 6 months half pay to help them through with COVID. You have a regular income, so therefore you can plan, you can budget. You're keeping financial control, and humans, just being humans, you like to be in control. But if you do retire, you have access then to the tax-free lump sum. And as we've said already, you can work less hours if you return. The consequences, again, educate yourself. Is my pension income of 10 or 12 grand a year sufficient enough to live off if I've just come from a £40,000 salary? Think of that. Is there a job to return to? A lot of people there's a job to return to, and unfortunately there's been nosebleeds and car crashes because there isn't. There is no given right for you to return back to any work. It's up to managers and HR to recruit. Is it a permanent position? But a lot of them are going back on 12 and 24-month rolling contractors. So basically you're turned into a contractor. Red, are you returning to work because your pension income is not sustainable? And I've just gone through that scenario with you. Are you retiring for the tax-free lump sum? If you are, we get it if you're looking to pay off your mortgage because that reduces your outgoings, and we get it if you actually regarding your sick pay benefit, if you are returning back to work, your sick pay benefit will not potentially be that good. Potentially there'll be no definite. Again, there's no pension for you to pay into, and you lose financial control. You're not in control because you may be on a temporary position or a contracting position. So as I've alluded to already, go back to the tax-free lump sum. We get it if people look to pay off mortgages because it reduces their outgoings, paying and potentially pay off university costs. But again, don't let the tax tail wag the dog. So the next screen is, look, if you do retire, you do have to have a gap in service. You are technically retiring. You have to walk out that door. And some organisations do want you to have a break in service. That's common, up to 24 hours or for more than calendar month. That does change from trust to trust. So please just concern with your NHS managers or your HR departments what that period of time out of work is, so you can actually know what your position of going back. Special classes, there is a thing called the abatement rule, which in essence means if you retire between the age of 55 to 60, then return back to work, you can't go back and earn more money than what you've done historically. All right, and we can touch on that with some questions at the end if you wish to, and we do provide an aftercare service, which we're a free aftercare service, which we're more than happy to allude to later. If you do retire and return, there is a thing called a defined contribution pension scheme, everybody. So what that means to yourselves is this is very similar to stakeholders, AVCs, your partners, your spouses, previous lives. Your money's invested. Simple as that. Your money will go up and down on a daily basis. Most people do this when they retire, they return, and 3 or 4 years max, maybe a bit longer, maybe a bit less. But is it a good thing? In majority of cases, paying money into a pension is a very good thing. You'll pay money into it. If you can afford to pay money into it, number one, that's a good thing. 2, NHS pay money into it as well. That's free money. Also, HMRC give you tax relief on the contributions. There's more free money there. And in anybody's book, free money is not a bad thing. So this is automatically enrolled. You have the right to opt out, but you will automatically be enrolled into Nest. Majority of people just see it's more like a cheeky little savings plan, really. You have the flexibility of taking out when you wish to, and the rules of withdrawing money from it are completely different to the 95 pension scheme. So winding down, this is a factor that's not thoroughly understood, or something that's completely bypassed because retire and return is the heavyweight. Winding down has always been there. It's actually another word for it's part-time work. So if anybody here is listening today is part-time, theoretically, in the maths of it, you are winding down. So what is it? First of all, let's just remind ourselves what your NHS pension's made up of. It's made up of 3 core factors. Number 1, your pensionable service. Now, this is your years, your months, and your days that you have worked for the NHS. As I said right at the beginning, when you get your total reward statement, it will tell you your calendar years, your overall NHS, but then your reckonable membership. Your reckonable membership is what actually you have done towards your pension. Pensionable pay to 37.5 hours a week. Anything above that is overtime, and okay, you're better off in your back pocket, but it does not go towards your pension. And thirdly, it's your accrual rate. An accrual rate is for the 95 an 80th, for the 08 it's a 60th, and for the 15 it's a 54th. 54 is better than a 60, and 60 is better than 80th. So this tells you the 2015 scheme from a mathematical accrual rate perspective is better than the other 2 schemes. 2015 scheme, everybody, is a good scheme. It's a good scheme. You have no influence on these accrual rates. There's nothing you can do about that, everybody. The only influence on is your pensionable service and your pensionable pay. So I've seen an example here, and we've got Janet again as our faithful example. Janet, she's in the 1995 scheme, and she works currently 37.5 hours a week, a 5-day week. Her full-time equivalent pay is £40,000 a year. Now remind ourselves, the 95 scheme is based on your best pensionable pay in the last 3 years, your best full-time equivalent pay in the last 3 years up to retirement. But Janet's had enough. She wants to go part-time. She wants to talk about retire and return, but she's decided to go to wind down. And so what she has done is gone part-time, and she's now doing a 50% hour week. So she's doing 2 hours a week, and she's doing half 37.5 hours, circa 18 3/4 hour a week. Her now income is now £20,000 a year, not 40. She's now taking home £20,000 a year. Now the common belief, everybody, is actually Janet's full-time equivalent pay now will be £20,000. And people don't do this because they actually generally think it affects their pension. They've gone from a 40 to a 20 grand salary. That's wrong. It's false, everybody. It is still based on your full-time equivalent pay. So even though Janet is taking home 20,000, her full-time equivalent is 40,000. And your total reward statement also clarifies that for you. Okay. So if she decides to wind down, her pension won't be based on 20, it will be based on 40,000. Where it will affect is actually more on the membership years, months and days. Because actually Janet's no longer doing a full-time year, she hasn't done 12 months worth of work, she's only done 6 months because she's done 2.5 days a week. Her pension won't increase by a 12-month period, it'll only increase by 6 months. Hence, again, the other example I used about certain ladies where you're part-time, you're doing your 2.5 day weeks because you're bringing up children. This is why you're finding your calendar membership of your pension is, say, 30 years, but your reckonable service is, say, 22, 23 years because you've been part-time in that period of time. So when you read your, as the bottom bullet point really alludes to, your total reward statement is based on your calendar length membership years. Your reckonable membership is the one that's actually relevant to your pension, everybody. So the positives of winding down: you remain employed, you're in a permanent position. You can potentially increase your working hours at a later time. So you know what, actually I want to do 3-4 days a week instead. You continue to pay into that NHS pension, which makes your pension benefits accrue better and better every year. You keep your death and service benefits. You keep your sick pay benefits, 6 months full pay, 6 months half pay. You're in control. And as I've said, humans, just by our being, we like being in control. You continue to receive a steady income. You've got the control of your income flow, your outcomes, just expenditure. And it's an option prior to retire and returning. I find retire and return can be quite a final solution. Let's explore the other options, the more flexible options first, before you do the outright retire and return. So please entertain this as well. So you've now come to a stage where actually you want to take the large lump sum or the low lump sum. So let's remind ourselves your options here. You've seen this slide before, but I'm now taking you to the red parts only. With the 95 scheme, you must take the tax-free lump sum. It's either 3 times your pension or 5.36. You have to take the lower, the higher, or something in between. The 2008 You don't have to take a tax-free lump sum, but you can go to a maximum of 4.28 of your pension. The 2015 is exactly the same rule. And what we mean by pension is if I've been told my pension is going to be 10 grand a year, 3 times 10,000 is £30,000, and that £30,000 will be my tax-free lump sum, and £10,000 income. Scenario here for you in the 95 scheme. I've alluded to this. Your pension a year is going to be £12,000. You times that by 3, that equals 36,000. But no, actually, I'm going to take the 5.36. That means my tax-free lump sum is going to be 64,000. That looks really good, but it will have a negative effect on my pensionable income, and it will be circa 9.5 grand a year. Everybody, before you even think about what I should take as a tax-free lump sum, high or low, the first thing you need to do is look at the pensionable income. If I know, and I do my income and expenditure, and I know that I need £11,000–12,000 a year to live off, I don't think I've really got much wiggle room. I think I must go for the £12,000 a year income, because that gives me peace of mind, gives me a guaranteed income. That income's inflationary, that keeps up the pace of inflation as well. I don't think I can entertain that larger lump sum, although that looked lovely in my bank account. I've got a 2.5 grand deficit between 12,000 and 9,500. It's 2.5 grand deficit. But then I get told, Neil, I'm going to invest that 64,000. I'm going to give it to you. I'm going to get you to invest an income from it, and you can get me the income from that. Surely you can get me 2.5 grand a year from 64,000. Look, let's make it very, very clear. Your money will be invested. Your money will go up and down in value. And I've got to then promise you, I can get you 3.5 grand inflationary linked for the rest of your life. Any good advisor will say, if you want an income and a guaranteed income, look at the first option at the top there, the £12,000 option potentially, okay? Just again, do your due diligence, do the income and expenditure first. What do you need to live off? That would be the driver. And exactly the same scenario of the 08 scheme. So again, income and expenditure, I've just touched on that. I think you're beginning to get the theme here. Absolutely a vital piece of information that is for yourselves. And then finally, thanks very much, Neil. I've got all these NHS pensions. I now will have these other pensions. My spouse, my partner got all these other pensions from previous lives, other working commitments, AVCs, stakeholders, etc. What do I do? What does it mean? Pensions never static. In 2015, there was a massive change in pension legislation, and from the advisory community, for the better. It gave everybody more flexibility of what they can do. Rather than just buying a default annuity, you've got other options what you can do with this money. I would strongly suggest, if you have got old pensions, old AVCs, final salary schemes, stakeholders, SIPs, private pensions, they need to be looked at by a professional. Because what we are finding is actually these are little golden nuggets, and they can certainly help. The scenarios I've set out earlier on about somebody retiring at age 60 but can't take the remaining money to their 67 because they're in the 95 and the 15 scheme, and there's this kind of bridging of years. How do they afford that zone? These schemes here have been their get out of jail cards. They've used this to help them phase their retirement. Please get them investigated, because the providers who send out the information usually only give you their options. They don't give you the wider options that you can have. They're all regulated and controlled. So please use that facility. It can be gold dust for you. Some of these old schemes are also golden nuggets, and they pay out fantastic benefits. And you need to know that as well, like guaranteed annuity rates. A fantastic option, fantastic option. There is a thing called the pension trap. Now, I'm not going to touch on this at all. Only Duncan Gaffney, very, very good at this environment. But if anybody on this webinar has had annual allowance statements, lifetime allowance, are high earners, are concerned about their pension being too much in the sense of having too much tax, paying too much tax, or have heard of annual allowance and worried about it. It's been in the press quite a lot, certainly over the Christmas period. I would strongly recommend you listen to his webinar, because he'll go into finer crunch and detail for you. You need to claim your NHS pension. It's called an AW8 form, Alpha Whiskey 8. Like anything, it's saying here, apply 3 to 6 months in advance. Based on the situation you are with the NHS at this present time and redeployment issues, I would strongly say, if you're looking to retire 1st of January next year, sorry, I would be saying I'll be contacting these people pretty much now in due time. If they tell you to clear off, come back in 3 months, that's fine, but you're in control. you know what you're doing and what you're ready to go. The amount of people want to retire tomorrow, and it's just not done that way. It is a process. There's actuarials that have to do all the forecasting for you, etc. NHS pensions, these are a fantastic bunch of people. We speak to them on a regular basis. I tip my hat off to them, wealth of knowledge. And so if you've got any information you need to know a bit more about your NHS pension specifically, like what is my retirement age? I've been moved over to 2015. What does that mean? When will I be moved over? I've got missing years. Speak to these people. They're certainly there to help you. They really are. Great bunch of people. So look, I've covered a wealth of information today. I've been doing this for over 20 years, and it's impossible to get that kind of experience across in the last 40 minutes. I've cleared up the main questions that we have. But what I would say, this is about you as an individual. It's about you and your team. And what I mean by your team, I mean by your family, your spouse, your partners. And if you want that retirement lifestyle, the sooner you start, the better. That golden box scenario, the one I opened up the slides with, is crucial. Know your total reward statement. Do your income and expenditure. That's that. I think you can see that preparation. Preparation's key. Understand what pensions you're in. When do you want to retire? Can I afford to retire? Speak to somebody if you need to, and we're more than happy to help you there as well. Because what we will provide for you is an aftercare service. We have always done this for everybody within the NHS free of charge for over 15 years. And after a seminar, some of you may have come across Eulogie before and attended one of those seminars we did back in the olden days when we used to see each other face to face in a room. Will come to us at the end and ask us questions, or fill in a feedback form and ask us to make contact with them at a later date. This is exactly the same principle. So if you've got any questions post this webinar, please send us an email, info@Eulogie. Just put your name, a brief indication you want to discuss, i.e. pensions, investments, etc., wills. Please please type code C2. The reason being is just for monitoring NI purposes. That's all that is. From an advice perspective, if you ever need financial advice, do your due diligence. We would always suggest you use a chartered financial planner or a company from a chartered status. It simply means you've got the highest level of planning advice going around. If you've got a relationship with a planner already, fantastic. If you haven't, just do your due diligence. For example, if somebody came to us today and wanted to do something, to manage expectations, it could take 2-3 months to complete that work. If somebody's saying they could do it in 48 hours, smell a rat, run away. There's fraud or something not right going on there. So again, just make sure you're doing due diligence. GDPR purposes, all your information is completely regulated by the GDPR. We do not pass your information to any third party whatsoever. Again, thank you for this afternoon. As I said, I know I've talked quite quickly and got as much information I possibly can do. Any information, just as I said, just please email us. But in the meantime, keep safe. Hope you keep well. Thank you very much for everything you're doing, and I will pass you over to Carla and David.
Thanks very much, Neil, and I'm sure everybody will agree there was a wealth of education there. So we're going to take questions. We're going to pass you to David. I can see that there are many questions in the chat box. Thank you, David.
Yes, we have some questions. I'll just rattle them at you if that's okay.
Yeah, sure.
Okay, could you provide any details about the pension age discrimination ruling with regards to timescales and possible remedies?
Is this relation to the fire service?
There was no further details, sorry.
Okay, so just to, this is again common question, but obviously like the fire service, they won a battle in court regarding people being moved in, typically like your 95 scheme into the 2015 scheme. To be honest with you, until we get further guidance, NHS pensions get further guidance, until government makes their decision, really, then as soon as we get that information, we can pass that on. Until then, there is very little anybody can do or advise upon, because we're kind of pretty much like the question there, why that individual's asked it. It's very muddy is the best word, and unfortunately, I can't give you a direct answer because we are out of the loop. We all are NHS pensions ourselves as professionals. It's just the fire service. It would have, though, let's manage expectations here. That could have a knock-on effect with obviously the NHS, the funding, national insurance contributions, how that would increase. It would affect the MOD, teachers, civil servants, etc. So the ramifications across the board for the whole public sector is going to be very, very expensive. But until we know what's going to go on, I can't answer that. I can't, unfortunately.
Thank you, Neil. Do national insurance payments continue when you take out an NHS pension if you don't have 35 years contributions?
Let me just read that right. It's if you work for the NHS, do you pay national insurance contributions?
Yeah, I think I'd read it that way. Do the payments continue when you take out an NHS pension if you don't have 35 years worth of contributions?
Sure. Okay. So I'll answer it in a round whole way, just in case I've missed something here. Okay. Number one, you only pay national insurance contributions on working income. So if I retire, I've just done that today. If I retire from the NHS age 60 and get my NHS pension income, I don't pay national insurance on pension income. But if I return to the NHS, I will be working for the NHS. And because it's below my state pension age, let's just say my state pension age is 67 and I'm 60 and I go to work for the NHS, I will pay national insurance contributions into that. But then let's overwrap this again. Let's kind of put some icing on this. Let's just say I've retired at 60 from the NHS and I've done 35 years. And if I go back to work, Neil, I would have done 36, 37 years worth of national insurance contributions. I'm afraid that, yes, that's correct. If you go back to work and you're below state pension age, you're highly likely going to be paying national insurance contributions. You only stop paying national insurance contributions on working income when you attain the state pension age, everybody. Sorry to say that. So some people will overpay. There's no doubt about that. There's no doubt about it. But good question.
Thank you, Neil. This next one made me smile, and it might make others smile. I am 42 and have never given any thought to my pension. Is it too late to start?
No. Perfect time to start. I'm of a similar age, and I think it goes really quickly before you, and you do wake up thinking, pensions, how do you spell that again? No. Look, I would rather speak to a 42-year-old about planning than somebody who's 2 days away from their 60th birthday. Because if that 42-year-old or anybody that they want to plan, let's do it now. Let's look at planning, because you've given yourself a massive margin of where you can do things, readiness for it. If I was given £1, and my colleagues will echo this, if we were given £1 for every person who's asked us, Neil, I need more money on their 59th birthday and they want to retire at 60, we can't magic money up. But a 42-year-old, 43, 55, you still got time to work with that. If you've gone past those ages, then yeah, absolutely, you're going to have to start looking at other methods, hence why you may have to carry on working. But no, definitely not. 42 is absolutely perfect. Perfect.
Thank you. If you retire at 60 on the 1995 pension, but are also in the 2015 scheme, is your 2015 scheme frozen with no penalties if you defer it to your state retirement payment age?
Yeah, just give me a second. I'm just going to bring that slide up for everybody, actually.
Yeah. This is something you touched on before.
Yeah, and it's fine, because again, when we're in a seminar live, we can start really focus on these questions. So they're really good questions, everybody. So let's just say Janet just asked that question. Janet wakes up on her 60th birthday. Look, Janet, you can pick up that pension, that 95 scheme pension from age 60 without no penalty. And there's no penalty to the tax-free lump sum either. But you've done the wise thing and just realised your state pension age is 67. And if you take that 2015 age 60, you're going to have a 7-year penalty, which is 31%. You don't have to take it. You don't have to take it. You can defer it every year. Every year, the penalty is less and less. Ideally, you would defer it to your state pension age, as I think you kind of alluded to, and then you wake up on your state pension age of 67. You've got kind of a double bubble. You're going to have access to your state pension, and you can have access to that 2015 money without no penalty.
Thank you, Neil. Some of these other questions are sort of related, but colleagues have asked them for good reasons. So even if they are in similar areas, I hope you won't mind, Neil.
Of course, no problem. No problem.
Next one is related. I have 2 previous pensions that I want to transfer over to the NHS pension. Is that possible?
Right. Yay and nay. Sorry for the political response. You can only transfer outside pensions in the first 12 months of employment. So that kind of usually blows everybody out because they've been working for like the NHS longer. However, I did allude that some people have private pensions, and they can kind of be used as gets out of jail cards. They can help with this phasing in process. So if you have these two other pensions from previous lives or personals, I would say get them looked at first, because the advantages are, if you've got private pensions, a typical defined contribution pension like a stakeholder or an AVC, you can take that money at age 60, 63, 55, 57 without no penalties potentially. So therefore what you've done is you've actually brought yourself some sort of flexibility, and it can help. If we just go back to the question we just had, say, from that imaginable Janet person, if Janet retired at 60 but can't take a 2015 scheme until 67, had some personal pensions behind the scenes, that could actually help bridge that financial income gap. So 100%, I would say they need to be looked at before you do anything like that. But the facts are, yes, you can put money into the NHS pension, but it's usually in the first 12 months of employment, which usually is gone beyond. I would get them looked at because there are so much flexibility. And when I talk about flexibility, I'm also talking about legacy flexibility. So actually, it can be passed through to your beneficiaries tax-free throughout, while actually your NHS pension's quite rigid when it comes to legacy benefits. So you do need to grasp the pros and the cons of it. You don't distinguish that.
Thank you. Who do you contact if you want to take the NHS pension at 60 but aren't working for the NHS at that time?
Go directly, and I know Carly and your good self will be sending out the slides anyway. NHS pensions, and I put the slides up here, so if you need to take a picture of that or things. So let's just say you leave at 50, you go and work for B&Q, you wake up when you're 60. If you haven't worked for NHS for 10 years, but you know you've got an NHS pension you can access at 60, I would say you apply at 59 and a half. As I talked about, a 6-month leeway, ask for it. We can go from there. But again, there's no penalties to take it beyond the normal retirement age. That's not a problem.
Thank you. Can you withdraw money from an AVC, or do you need to wait until retirement to access this? And will the income from this be taxable?
Okay, so there's questions there. Right. AVCs, it kind of links over to the question we had about 2 questions ago. An AVC is a private pension, typically it'll be a defined contribution pension. So you can access, rules are right now, you can take this money from an AVC from age 55 upwards. However, it depends how that AVC is linked. Is it linked to a certain employer, etc.? So the DNA of that pension has to be looked at first for you before you kind of make those decisions. But yes, in essence, you can take it out. In the majority of cases, you can take it out. Now, is it taxable? An AVC will be a defined contribution pension, as I said, like Nest. You are allowed to take 25% of it out tax-free. And that can be typically as a lump sum, or it can be taken as a 25% income tax-free. But the remaining 75%, everybody, is taxable at your marginal rate. So there is taxation there. There is a potential taxation there. Again, they need to be looked at.
Thank you. I'm going to jump one and come back, because this one relates to one you answered a question or 2 ago. Neil, does the 12-month limit for pension transfer into the NHS pension apply in this current climate? Now, there's a reason why this colleague has asked, but I think the question stands by itself. Current climate meaning where, generally speaking, a lot of things are currently on hold.
Yeah, look, I can't, I'll be absolutely honest with you there. That would be something I would strongly suggest contact NHS Pensions Director. I've just put the slide back up on the screen. You're looking, obviously, I presume, before retirement. Give them a call. Give them a call this afternoon. Great bunch, and they can put that to bed for you. So definitely, so I can't answer that question head on that one, unfortunately.
Fair enough.
I think we've got just time for one more question before we close.
Okay. Fine, thank you. Final question, Neil. For the state pension, do you need to work 35 years full-time? Also, is there a minimum number of years you need to pay into the NHS pension?
So,
two last questions, really.
No problem. Give me a couple of seconds. I'm just going to bring that slide up. So the third bullet point down here, everybody, your minimum is 10 years. Your maximum is 35 years to get the maxed out pension there. Sorry, just remind me the question again, because I kind of was busy going through the slides there.
No problem. For the state pension, do you need to work 35 years full time? Is there a minimum number of years you need to pay into an NHS pension?
Okay, I've just answered the 10 to 35 years. Thanks very much, David. Right, part-time. Really good question. So this is a real life scenario. I'm full-time. My wife is part-time. She does less hours than I do, but actually she is still paying to the national insurance stamp, and therefore she is still on track to have a full state pension, although she is part-time. So that doesn't matter. And national insurance is a percentage of income. What they're saying is absolutely right from a percentage perspective. If you earn X, you will still pay the percentage, and that's how it would work. It all goes into the pool event. What you just need to make sure there is, if you're so part-time, and I mean so part-time is some kind of student, like between university and sixth form type student, where you may not pay any NI because you're just earning such a low income. But typically, if anybody's got a job that's 2-3 days a week and they're part-time that way, typically they're breaching the national insurance contribution, which allows them to contribute to the national insurance pot, which then echoes that they're on track for the state pension. But what I will, to overwrap that for everybody, for that takeaway, get that government forecast, get that state pension government forecast, because what that would do is that would detail it directly to you as an individual, and absolutely put that your mind at rest on that type of question. I hope that helps. I hope that helps.
Very much. Thank you, Neil. That's all from me.
Thank you, everybody.
Thanks, David. Thanks, Neil. I guess before we leave today, it's just to be sure, and everybody can be confident that we've captured all of your questions in the chat box, and we will reply and send them through as an FAQ sheet to all of your email addresses. But I wanted just to reiterate some of the tasks that Neil's asked you to do today to help with your pension, your retirement and your future financially. Please do your income and expenditure sheet. We will send you a template that Neil's kindly put together for us. Do also request your total reward statement. If you are unsure how to find this, quite happy for you to email us at agem.od@nhs.net. I'll put that into the chat box shortly. And also your pension forecast. Again, if you're unsure how to make contact with the pensions, please let us know, but we will send it through in the FAQ sheet as well. Finally, and I'm sure Neil will also reiterate, Neil has offered one-to-one calls with himself and his colleagues at Eulogie. Please do email them on the email address you can see in front of you. Neil, do you want to do a little bit more sort of a showcase around that, and I'll say thank you?
Yeah, sure. Typically, back in the olden days when we used to do this all face-to-face, and we have done a number of webinars over the years, but we would send out a feedback form. People will want to speak to us. Obviously, they can't do it over a chat box because they're only very limited, and you're doing things as a combination of a group of people. If you contact them individually, we eventually have the responses you'll get are going to be more tailored and individual to your circumstances. And there is no shadow of doubt that what I've just gone through in the last 40 minutes, you will need to know again and again, because as humans, we just need to complete that tune to keep falling on to us. So look, it's free. It's always been free. We're more than happy to do this. And it's good for you, it's good for us, it's good for people like David and Carla, but it will be more directed at those current circumstances. And a lot of it is just direction and putting in the right direction. And even if you've got questions about your partner's pensions, etc., again, we're charters, but we have to know about pretty much everything pension related. So we're more than happy to speak to them as individuals. Not a problem.
Lovely. In that case, I'll say thank you, David. Thank you, Neil. Thank you for everybody for joining your Wellbeing Wednesday lunch. If you'd like to join us next week, we are talking and discussing through wills, power of attorneys, death benefit forms, and all those things in terms of what you need to know in a current climate of death, wills, testaments, etc. You've all got the links, but we'll resend them through. Thank you for joining us today.
Okay. Bye-bye.
Thank you very much.